Hey guys, welcome back. This price action course will not be complete if I don't talk about the market volumes. Throughout this course, our focus was strictly on prices. For the success of price action in market, volume plays a very pivotal role. Be it the identification of trends or patterns, be it finding out the breakouts and false breakouts, be it the entry or exit from the trade, volume is a necessity. As you may know, volume is a leading indicator, which means that it precedes the prices. Or simply, before something happens in the price, the volume will show the changes beforehand. So our duty as a trader is to find the relationship between the price and volume, so as to get an edge over the market or even to predict the market moves beforehand. So let's hop in right away without wasting any time. Basically, volumes indicate how many shares are bought and sold over a given period of time. So the more active the share, the higher would be its volume. For example, you decide to buy 100 shares of Tata Motors at Rs 485. At the same time, I decided to sell 100 shares of Tata Motors at 485. Or it can be different people who want to sell a smaller quantity at the same price, that is 485, which are accumulated together to give you 100 shares. That is, let's say one of them has 50 shares, the other one has 30 shares, and the third person has 20 shares. To sell at the same price of Rs 485, which will be matched with the buyer. So basically there is a price and quantity match which results in a trade. This means that you and I have together created a volume of 100 shares, or you and the other 3 sellers which we have talked about created a volume of 100 shares, because if you notice, overall 100 shares were transferred from the seller to the buyer. Now many people tend to assume the volume and count it as 200 because 100 were bought and 100 were sold. But this is not the right way to look at volumes, because only 100 shares transferred hands from one person to the other. With that being said, the volume information on its own is quite useless. For example, we know from the NSE website that volumes on Reliance India for this particular day is 16,700,000 shares. So tell me, how useful is this information when read in isolation? So if you think about it, it has no merit when used individually, and hence it would actually mean nothing for our analysis. However, when you associate today's volume information with the preceding trend in the price and the preceding trend in the volumes, then the volume information becomes more meaningful. Now, I will show you a table that consists of 4 price to volume relations for different conditions and the related outcome that is expected under such conditions. Now, before going ahead, don't fall into the conclusion that if you understand the relations provided here, you can trade right away. It doesn't work like that. In order to use this idea in market conditions, you should have a fair idea about the market structure and the participants in the market, of which you need to understand how the big players or institutions work. And number 2, you need to have a good understanding of the candlesticks and their relevance at different price areas. If you know these 2 things spot on, then this will just be a walk in the park. For those who don't have an idea, I recommend you to watch these 2 videos beforehand that we have already discussed earlier in our course. Before we understand the price volume trend table in detail, think about this scenario. When we are talking about an increase in the volume, what does this actually mean to a trader? What is the reference point, or what is the metric to say if the volume is high or the volume is low? Should it be an increase over the previous day volume or the previous week's aggregate volume? What is the reference point? As a practice, traders usually compare today's volume over the average of either last 3 days or last 5 days or last 10 days or even last 20 days volume, depending on the type of trader they are and what exactly is their time frame for analysis. Generally, the rule of thumb is that higher the time frame and higher the number of volume bars or data taken to calculate the volume, the more reliable the analysis is. For the sake of this video, let me consider the volumes from a swing trader's perspective. That is a 1-day time frame and 10 days of volume data for the average volume measurement. After the average volume measurement is done, we can use it for the comparison of today's volume. Now today's volume is said to be the average volume if it is equal to the last 10 days average volume. Now if today's volume is said to be higher volume or is said to be an increasing volume, then it is greater than the last 10 days average volume. And finally, if today's volume is said to be a low volume or a decreasing volume, then it is less than the last 10 days average volume. In order to get the last 10 days average, all you need to draw is a moving average line on the volume bars and the job is done. This feature is available on most charting platforms for free, so you don't have to calculate it by yourself every time. As you can see in this chart, the volume bars are represented as red and green bars and is placed at the bottom of the price chart. The blue line that is overlaid on the volume bars indicate the 10-day average volume. As you notice, all the volume bars that are over and above the 10-day average volume can be considered as increased volume. Now the question is, what does increased volume necessarily mean and why is it important? Well, increasing volume means higher trading activity than usual, which means more shares are being exchanged hands. Now, who do you think will be responsible for this? Can retail traders by themselves contribute to such high volumes single-handedly? Common sense tells you that it is not possible, and it's obvious that there is some institutional activity or large participation by some big players has taken place. On the same note, what does a lower than average volume mean to a trader? It means that big institutions or big players are not interested in the particular stock at that period of time, and the major volume is contributed by the retail participants and speculators. So the simple logic in stock market is to follow the big institutions if you want to be successful. We have discussed this in the market structure episode. Okay then, let's look at the thought process behind the volume trend table. When institutional investors buy or sell, they do not transact in small chunks or small quantities. For example, think about LIC or Life Insurance Corporation of India, which is one of the biggest DII or domestic institutional investor. Now, if they were to buy the shares of TCS, would you think they would buy 500 shares or 1000 shares? Obviously not. They would probably buy 5 lakh or even 50 lakh or even more shares. So what happens if they were to buy 5 lakh shares from the open market all in one go? Yes, it would definitely start reflecting in the volumes. And besides this, because they are buying large chunk of shares, the share price also tends to go up. Now this is where I have to remind you that institutional money is referred to as smart money. It is perceived that smart money always make wiser moves in the market than most retail traders. So being smart or wise, they would not just buy all at once. Rather, they would accumulate the shares in small quantities over a period of days or weeks or even months so as to get the desired price that they want to buy. Now most traders have a misconception that when the volume is high, the price will also move up or down with larger candles depending on the color and size of the volume bars. But this is a wrong way to understand the price-volume relation. The thing is that volume is the number of shares that has traded hands, which can also mean that the orders can also be at a single price point. For example, let's say there are 10,000 buy orders and 10,000 sell orders, all at rupees 400 of a stock. And let us say that the average volume of the stock is 8,000 for the last 10 days. Even though the 10,000 shares were exchanged, resulting in a higher than average volume for the particular day, the price will not move up. The simple reason being, all the orders are placed at the same price, that is rupees 400. On the other hand, if the price were to move up with an increase in volume, then there should have been more buy orders at higher prices. That is, buyers should be willing to buy at even higher prices. And a similar case, if the price were to go down, then the sellers should be willing to sell at even lower prices. And it is at these instances we can leverage an increase in the volume for our trade decisions and not otherwise. The case is the same when the volume is low. The low volume does not necessarily mean the price would not do anything. It is just that the number of shares exchanged hands are a lower number. But there is still a possibility of buying or selling interest where the orders can be placed at higher or lower prices by the buyers or sellers respectively. Then there is a definite chance that the prices can do something. But on the downside, The big players are not interested in this particular stock, and it leads us to the conclusion that the price move was supported by retail traders, which is actually evident from the lower volumes. And hence, following the smart money is the wisest idea that you can have as a trader. Well then, we shall discuss each of the 4 cases in detail. If both price and volume are increasing, this only means one thing, that a big player is showing interest in the stock. Now, going by that assumption, the smart money always makes smart choices, and the expectation of the market turns bullish. The institution build their position slowly and gradually, but sometimes there won't be enough liquidity at a price where they want to buy, or simply there are not many sellers who want to sell at the price that the institution wants to buy. What this does is that it will in turn push the price higher. Keep in mind the fact that the quantity that these big players take for delivery is huge, and therefore every rupee is worth lakhs for them. And due to this reason, the institution starts to sell some quantity, which will in turn bring the prices down to where they want to buy. And because of this, the panic sellers would sell off the stock at the former price that the institution wants. And this phase of position build-up will look similar to an accumulation or consolidation in the chart. Once the institution finishes placing all the orders, that is when the market actually starts to move higher, and this is the time when the retail traders actually start to notice that the market is starting to go higher, and even they will start to join the party by buying the stock, which will push the price even higher. So this is the reason why one should look for buying opportunities in the stock, because the expectation turns bullish when both the price and volume increases. Now, whenever you decide to buy, ensure that the volumes are substantial. This means that you should be buying along with the smart money. Also you have to look for bullish candlestick patterns like hammers or engulfing candles to confirm your trade entry. You will find more details regarding this on my candlestick video. Now, all is well if you are an intraday trader, but if you are a swing trader or an investor, you will have to keep an eye on a third parameter, which is either the delivery volume or the delivery percentage. Now, delivery volume is the volume of the stock delivered to actual buyer out of the total traded volume, or in simple terms, the shares which were taken as delivery for the particular day. And here ago, we need to go through both these parameters, because the delivery volume would also include the BTST trade, that is buy today, sell tomorrow trades, which will not give the correct picture. So we also had to keep an eye on the delivery percentage. But now, since the BTST trades are stopped, we can consider any one of them. You will get the delivery volume details on the NSE website. I will put a link to it in the description box. Now, the importance of delivery volume is that it gives you the real picture of the interest of big players or big institutions. If the big institutions start buying, they will take the shares for delivery. If you can see a rise in the delivery volume or delivery percentage for a few days, you will understand that there is a real buying intent in the market. Also understand that even if the overall traded volume is very high, it does not necessarily guarantee that the delivery volume will also be high, or simply it does not straight away mean that there is an interest from the investors. It can be seen as a heavily traded day and nothing else. Moving on to the second case, what do you think will happen when the price increases but the volume decreases? Think about the situation in the following terms. Number 1, why is the price increasing? Simple answer, because the market participants are buying. Easy, right? Are there any institutional buyers associated with this rise in price? The simple answer is it is not necessary that there should be institutional buyers associated with the price rise. Now the critical question, how would you know that there is no meaningful purchase by the institutional investors or the big players? Now, using the basic rule, if they were buying, then the volumes would have increased and not decreased. In this case, the price increased but the volume has decreased. Now, what does the price increase associated with a decreasing volume indicate? It means that the price is increasing because of small retail participation and not really the influential buying by the big players. Hence, what this price volume relation is telling you is to stay cautious in the market because it would be a potential bull trap. That is, if you have taken a long trade, there are every chances that the market can reverse and go in the opposite direction, resulting in your loss. So, when it comes to decreasing volume but with increasing prices, we should be cautious and not to take any long-term trades because the market is run by the retailers and there is no investor participation or investor interest in the stock. Going forward, the third type is a decrease in price along with an increase in the volume. This particular relation between price and volume sets a bearish expectation in the market. We will discuss why. First question to ask yourself, what does a price decrease indicate? A price decrease indicates that the market participants are selling the stock. But on the positive note, an increase in the volume indicates the presence of smart money or the big institutions. Now, clubbing both events together, that is decrease in the price and increase in the volume, it simply implies that the smart money is selling the stocks. They do this gradually so that the market participants won't panic. Think about it. What would have happened if they place large sell orders all at once? It would definitely be shown in both volume and price. That is, the prices would drop and the volumes would increase. This will further induce panic in the retailers who will further start selling. And because of this extensive selling, the prices would even drop further. And the institutions will not be able to sell at the desired price that they want. And this would directly affect their profits really badly. Being smart, they would sell the shares in small quantities slowly and gradually and generate the ample liquidity to sell at the desired price that they want. Now, going by the assumption that smart money always makes smart choices, the expectation in the market is bearish and we should look for selling opportunities in the stock. Now, whenever you decide to sell, ensure that the volumes are good. This also means that you should be selling with the smart money. And also use bearish candlestick patterns for your trade entry and confirmation. If you are a swing trader or an investor, it is a good practice to look at the delivery volume or delivery percentage, which in this case would be decreasing since the investors are selling their shares. Now, an increase in the volume does not necessarily mean an increase in delivery volumes. Moving forward to the final case where both the volume and price decreases. Ask the questions. Number 1. Why is the price decreasing? Simply because the market participants are selling. Question number 2. Are there institutional sellers associated with this price decrease? Simple answer, we can't be sure about it. Now the most critical question, how do you know that there was no meaningful sell orders by the institutional investors? Straightforward answer, if they were selling, then the volume would have increased. But in this case, the volume decreased. And what does a price decrease and a decrease in volume indicate? It means that the retail participation is the reason for the decrease in prices and not really the influential selling. So this is a case where you have to be cautious if you are planning to sell the stock, as it could lead to a possible bear trap. That means if you have shorted a stock, there is every possibility that the stock can reverse and go against your trade. Now that is it for this video, guys. If you want to know more about analyzing delivery volume or delivery percentage for your trades, do let me know in the comments. And if you have learned something new, drop a like and don't forget to subscribe to the channel so that you don't miss out on the upcoming videos. I will see you guys in the next video.